This is the SMSF property trap, and why buying property in super isn't the shortcut you think it is. That's right, folks. You think buying property in your super sounds smart, right? You think no impact on your personal lending, tax perks, long-term retirement growth, and you think, sounds like I've hacked the system, right? But here's the catch that nobody tells you guys. Unless you know the SIS Act from your elbow, you could be buying a compliance headache in a trust structure you don't even understand. And don't even get me started on all the property spruikers on IG, LinkedIn, and even YouTube selling 6% return to the side of legal disaster. In this video today, I'm unpacking the reality of using your super to buy property. In this video today, we'll go deep into what you need in your SMSF to qualify. And spoiler alert, it's not 50k and good vibes in your super fund. The lending rules, LRBAs, and liquidity traps most brokers won't tell you. Also, the real understanding criteria and formulas behind the approvals, and why people are getting burned for signing in the wrong entity. And also how to actually use the SIS Act to your advantage. I'm telling you guys in this video, this is a savage truth teller for anyone thinking of putting bricks inside their super fund. So right off the bat, guys, firstly, you need more than just a super idea. And I'm talking about the minimum balance requirements in your super. You might be thinking, hey Q, I got $50,000 in my super. Yeah, I know it's technically legal to buy property in your SMSF, but I'm telling you, lenders will laugh at you if your current retail fund has anything less than $200,000. I'm telling you, most SMSF lenders require your fund to have at least $200,000, which is roughly 40% of the property value if you want to borrow anything from the banks. To quote Canstar, you guys know Canstar, right? They said, quote, a minimum viable fund should have $200,000 to $250,000 for residential property investment, end quote. But then to counter that from some aggressive mortgage aggregators or those ads you see on LinkedIn, YouTube, TikTok, whatever those bloody property spruiker SMSF ads, they'll say to you, quote, you can start with less if the deal is right, end quote. Wink, wink. And guys, this is my opinion. That's like saying you can run a marathon in your flip-flops or your thongs or your Havanas if the weather is nice. Like, it's technically true, but you'll regret it, guys. So to play it safe for most of my clients, this is the formula check for SMSF borrowing. If the purchase price is $600,000, the usual LVR for our apartment price, for example, you can't buy a bloody house for $600,000. For apartments, the LVR is 70% LVR max. That gives you a loan of $420,000. And then you have to throw in the deposit, right? You then need $180,000 plus stamp duty, plus legals, plus a 10% liquidity buffer post-settlement. For example, another $60,000 in cash, because a lot of lenders don't like you having all your super invested in property. And right now, I know a lot of you guys watching this and other brokers that are sitting behind their keyboard watching this, watching me say something wrong. I know you guys are watching this. You might be thinking, hey, there's some banks that don't have the liquidity test. Like, I can get my client to have all their super put into the property and the deal's done. Yes, I know. Some of those non-banks do that, but is that ethical? Is that good financial advice? Is it a freaking good idea to get a client to rip all their super with nothing left and put it into property? I'm telling you guys, always have a 10% liquidity buffer in your super. Have some cash reserved just there in case this decision is wrong. And for those of you who think, oh man, you're just being too safe, you're being conservative. Yes, I am being conservative because that's your bloody nest egg. And for anyone that says otherwise, are bloody property spruikers. Because you know what? They just want you to buy their property and get the commission. Secondly, guys, you must use a SMSF plus Bear Trust plus LRBA. And right now, you might be thinking, Q, what the hell is a LRBA? That is some bloody context jargon. Well, LRBA stands for Limited Recourse Borrowing Arrangement. Limited Recourse Borrowing Arrangement. And right now, if you hit this far in this video, it gets complex fast. So let me slow down delivery here, right? Because I know a lot of noobs are watching this, right? I'm telling you right now, you can't buy a property in super without a SMSF. That stands for Self-Managed Super Fund. If you want to buy property through super, you need to set up a lot of things. For example, a SMSF fund, a Bear Trust, which holds the SMSF trust, and a LRBA, Limited Recourse Borrowing Arrangement. And a lot of you right now be like scratching your head and go, Q, what the hell is this? This is all this legal jargon, all this trust jargon. I don't really get this stuff. Guys, just slow down. Let me quote CPA Australia just to calm your nerves. CPA Australia says, quote, borrowing in super is a sophisticated strategy that requires careful structuring, end quote. So if you've been hearing a lot of things that are counter to that, for example, a lot of SMSF property promoters, they'll say something like, quote, "It's not hard if you have the right team," end quote. "It's not hard if you use our one-stop shop team to do it all for you by paying a small fee, like what, 10 grand or 15 grand, end quote. Like, what I'm trying to say, guys, is it's not hard or it's not easy, but it gets less hard if you do have a lawyer or a solicitor, a tax advisor, like for example, an accountant, a mortgage broker. It doesn't need to be me, but it needs to be someone that's unbiased, who all knows the SIS Act backwards. Like, it can't be from some ad that you saw on Facebook and they're like one-stop shop. Everyone is in that one-stop shop, right? Because if you get this wrong, like for example, you sign your personal name instead of the trust entity when buying that property, I'm telling you right now, according to the SIS Act, you'll blow the whole deal away. Thirdly, guys, SMSF lending is a minefield. Because I'm telling you right now, only a few lenders are even playing in this field. All the major banks are out of this field. Too much compliance. Only non-banks, and even certain non-banks don't do it. Only certain non-bank SMSF lenders are doing this right now. So right now, if you're watching this video, you might be wondering, well, what do I need to expect out of an SMSF lending? For me, I'll say to be safe, expect 70% for apartments or up to 80% for houses. But if you want to be really conservative, stick to 70% OER. So you'll always have in your mind, I need a 30% deposit plus stamp duty and all the other costs. And in terms of the variable rates, they're usually 2 to 3% higher than standard investment rates. Although I've seen a lot of non-banks move rates from 6.9% to 7.5%. It depends on what property you buy, whether you want an offset account, whether you want a fixed rate, and whether you want interest only, and all the other bells and whistles. And even though certain banks don't require the 10% liquidity test, I strongly suggest you, no financial advice, have a requirement that you have a 10% cash buffer after all that money goes into the property that you buy under SMSF. And most importantly, guys, most of these SMSF lenders would require you to get financial advice from an independent financial advisor. For a lot of clients that go with us that want to buy under SMSF, we always send them to their financial advisor or our independent financial advisor to get the pros and cons. Sometimes when we talk to a client, they're really keen on buying an SMSF property. They service for the SMSF property. We can get them a pre-approval for SMSF property. But when we send them to a financial advisor and the advisor goes, nope, that is not good for you, according to this advice, which is independent with them and the client, we accept it. We don't push. We're like, hey, we don't give financial advice, but if the advisor says this is not good for you, maybe it's not good for you. Now, to quote Bank of Queensland, like a representative over there, they said, quote, "We require post-settlement liquidity to protect members," end quote. But then if you look at SMSF forums on Reddit or whatever, right, you'll see people saying, quote, "This limits what investors can do with their own money. This is their money," end quote. And this is my savage take, guys. There's a lot of cowboys in this market. You might be thinking, man, I want freedom. I want to do whatever with my super. But then over here, we have all this compliance babysitting, right? Oh, 10% liquidity. I shouldn't be bounded by that. But have you ever thought about it? What if they're doing that to protect you? Now, fourthly, you can't just buy any property, right? The SIS Act will slap you in the face and say, no, 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 especially if you're going to buy a property with the intention of constructing or improving that property. What I want you to get out of this video, if you get nothing at all, just remember the sole purpose test. And the sole purpose test is a legal non-negotiable policy under the SIS Act. And let me translate that to you. Your SMSF can only exist to provide retirement benefits. What that means is you can only buy a single acquired asset, which means you have to buy the property as is. You can't make improvements to it. Also, on top of that, you can't live in the property. And also, you can't rent it to family or buy it because it's a cute holiday house in Byron. According to the ATO annual report, they said, quote, "Sole purpose violations are a leading cause of SMSF audit breaches," end quote. And according to the SMSF Association, they said, quote, "Many trustees just don't understand the rules," end quote. And right now, guys, you might be thinking, oh, what the hell? I didn't care. If I breach, I breach it. But let me tell you this. If you fail this, you could be taxed at 45%. That's not a slap on the wrist, guys. That's a financial uppercut. I'm telling you guys, there are fines and penalties if you breach the SIS Act when buying property through super and you don't adhere to the rules. Now, fifthly, you need an investor mindset. And I'm not just talking about like just an escape plan, like, oh, I have an escape plan just to exit. No, I'm telling you right now, buying property in super isn't a cheat code. It's a serious strategy that should be about long-term yield, stable tenancy, and eventual capital growth. This strategy is very suitable for those that are around 40 to 45. If you're past 45, well, it's kind of too late. Nah, it's not too late. You can still do it, but it's a transition to retirement strategy. And this type of conversation, you got to have it with your financial advisor. Because right now, I know there's a lot of people on this app, on this platform, mostly bloody buyer's agent, pretending to be the financial advisor, pretending to be the accountant, pretending to be the mortgage broker. They come out all charismatic. Oh, you can buy this under this and this and that. This is how you do it. They have no qualification as an accountant. They have no qualification as a financial planner. They shouldn't be even giving bloody advice on TikTok, on YouTube, or IG, but they still do it. Those guys are the dodgiest mofo ever. And I know a lot of you think, oh, Q, you're just having a rant. You're just hating on them. They're getting all these likes and all these views, more than in your long-ass videos. Let me back this up from a quote from an ASIC commissioner, which are investigating those people at the moment. They say, quote, we've seen too many SMSF trustees buy off-the-plan duds from sales seminars, end quote. Sales seminars. You know what I'm talking about, right? Those evening, free lunch, free booze, come and learn about buying property under SMSF. You know those bloody seminars? But mind you guys, I'm not hating on people who are buying property through SMSF, because according to the Financial Planning Association, they say, quote, with proper advice, property in SMSFs can be a great diversification strategy, end quote. Like guys, this is what I'm trying to say. I don't want you to confuse freedom with laziness. Like what I'm trying to get in your brain right now is that SMSF property is high stakes, high costs, and it also needs a serious stewardship. Right? Because guys, this is where Instagram roast. This is where the property roast comes in. Let's be real, guys. Most people buying super are sold the dream by developers or promoters who don't care about compliance tails. Like the mob in Canberra, they keep warning about SMSF property risks, but then they left the gate so open for years. Like asset only steps in after people get burned, right? I have a lot of clients that bought under SMSF that was sold the SMSF dream by these one-stop shop, whatever instant property groups out there. And the property isn't doing anything at the moment. It's actually losing money. And those people who work with those unscrupulous banks that are lending without the 10% liquidity rule, basically they're lending you the money plus a rope to hang yourself. So yeah, like buying property is powerful, but it's not a shortcut, guys. It's not a get-rich-quick scheme. So guys, if you watch this part of my video, this is my closing statement. Buying in super can be very smart, but it's not simple. And if you don't know the trust structure, the liquidity tests, plus the tax impacts or the underwriting logics, you're not investing, guys. You're gambling in legal slow motion. So guys, if you're serious about buying property in SMSF, I suggest you do your due diligence. Speak to me in either a 50-minute strategy call or a 60-minute deep dive. I'm getting booked out this month, but I still have slots for your serious consults. I want you, if you want to buy property in super, to have an independent strategy consult with my financial planners, my accountants, and also my different buyers agents that don't work with us. They're all separate companies, not a one-stop shop, for you to do your due diligence to set up your dream property portfolio under SMSF and build generational wealth. So when you transition to retirement and actually retire, you can live on the $150,000 to $200,000 annual pension that you've always been dreaming of. But then guys, if you're not ready, just hit the like button, hit the follow button, smash the share button, share this knowledge to your mates, because remember guys, knowledge is power. And again guys, thank you for watching another episode of That Property Roast, and I'll see you in the next few days.